The legendary investor Charlie Munger, associate of Warren Buffett, surprised a lot of people when he bought a large stake in Alibaba, the Chinese company, last year. However, this month, April in 2022, he's actually sold half of that stake. So in this video, we look at the reasons behind that, but more generally, for our portfolios, is it time to buy emerging markets and China right now? So let's look at Charlie Munger, Alibaba, and Chinese equity in a bit more detail. Now, Charlie Munger actually manages the investments of Daily Journal Corporation, where he used to be the chairman. And in this interview, he's talking about why he chose Alibaba, and it's in reply to a question where somebody's saying that Jeffrey Gundlach, another famous investor, is actually saying that China's uninvestable.
Well, of course, only the future knows who's going to be right. But China is a big modern nation. It's got this huge population and this huge modernity that's come in the last 30 years. And we invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security than we could get in the United States.
So it's partly about the strength of the enterprise, how strong is Alibaba versus its competitors, but it's also about value. What does $1 buy you today in terms of future growth? And if we talk about uninvestable markets, well, one man's uninvestable market is another man's opportunity.
I'm sympathetic to Gundlach. If he's nervous, he doesn't have to join us. Different folks have different opinions. I feel about Russia the way he feels about China. I don't invest in Russia, so I can't criticize Gundlach's point of view. It's just I reach a different conclusion.
Now, Alibaba is not just a retailer. Just like Amazon in the US, it also sells cloud services so that other companies can use its infrastructure to sell their own goods and services. Now, if you look at the research firm IDC, they say that the Chinese cloud industry should have a growth rate of over 30% until 2025. And it turns out that Alibaba has a 1/3 market share in that cloud industry. So there are reasons to be optimistic about future earnings growth. However, if you actually look at the timing of the purchases, which we can roughly figure out from the 13F filings for the company, you can see that he started to build up his stake in the middle of 2021. That's when he bought about 165,000 shares. And these are ADRs, so this is not direct stock of Alibaba. It's indirectly linked via something called a variable interest entity. But at the time he purchased, you can see that the price started to fall fairly sharply. But he didn't give up. You can see that he doubled down on his bet, as we can see from the October filing in 2021, where the number of shares doubles to 302,000. Then the share price rallied for a bit and it fell again, and then he doubled down again. So at this point he had 600,000 shares. The stock price didn't stop falling, but then at the beginning of this year, in April, you can see that it seems as if he capitulated when he halved his holding to 300,000 shares. And if we look at how much the stock price fell, well, from the time of his first purchase to his second, it was about 30%, then another 23%, then another 15%. And since he halved his holdings, I guess he's kind of happy about that because it fell another 15%. Now, we don't actually know the reasons for these sales. He hasn't said anything on record. It could be because he's moved away from ADRs on the US market and perhaps bought directly in Hong Kong, or it could be the fact that he just needs the money for the company. It may have capital requirements which are outside the scope of the investments. Now, Charlie Munger is not the only famous investor who's keen on China right now. So is Jeremy Grantham. Here's Grantham being interviewed on Bloomberg recently, and his role is Chief Investment Officer at Grantham, Mayo and Von Otterloo, that's GMO. And at the moment, his opinion is that you should avoid US equities. That's because he thinks they're in a massive bubble and that they're massively overvalued. So instead, he chooses to allocate to regions where valuations aren't as high, in particular emerging markets. Now, you can bet that Alibaba would be part of that holding because its valuation multiple is very low compared to US companies which are in tech, for example. So if we look at the price to earnings multiples across different countries at the moment outside the US, you can see that in emerging markets, China is actually one of the cheapest. This arrow actually points to China's valuation most recently as of April the 14th, and that multiple, the forward multiple, based on the forecast earnings, is just 10.3 times. If we compare that with the US, that's trading at almost double the valuation, so that's 19.6 times. So even amongst emerging markets, China's also looking relatively cheap, but of course that's for a reason. Now, if you want to learn more about investing, then a great way to do that is as part of our online community, which we now manage on our website, pensioncraft.com, and that gives you access to all sorts of goodies like members-only videos and our Slack application so you can ask questions whenever you like. And if you want to learn more about that, just click on the link beside me and in the description beneath me. The general perception is that Chinese equity is not supported by the Chinese government, but they tried to turn that around on Intervention Day. So you can see that in March, the CSI 300 index for Chinese equity was falling very precipitously until we reached that announcement by the Chinese government. After that, you can see that it supported equity for some period of time before equity started to sell off again. Here's the Chinese Vice Premier, Liu He, who's actually making that announcement. And the general idea was that they were going to support both the economy, but also the equity market with some friendly policies. The Chinese government was clearly aware of the fact that their equity market was in big trouble, and there was a meeting of the State Council's Financial Stability and Development Committee, and one of the outcomes of that meeting was that they were going to boost the economy in the first quarter. How could they do that? Well, one method is to cut the amount of reserve requirements. That's the amount of capital which banks have to hold with the central bank, and that means they have more capital which they can lend to companies and households. That should stimulate the economy. And they also stated that they'd come up with policies which are favorable to the market, although in terms of practical policies, those are quite difficult to find since the announcement. Maybe the only tangible one is that they reassured markets that variable interest entities, remember those ADRs that Charlie Munger had bought on the New York Stock Exchange, well, those are linked to the value of Chinese equity and Alibaba via these VIEs. And what the Chinese government said was that they support companies from across industries to list abroad, i.e. VIEs would carry on working. So the relief from Intervention Day was fairly short-lived. And if we look at the bigger picture, it's easy to see why. This beautiful graphic from Finviz shows you the size of each of the markets outside the United States. Now, the area of each block is in proportion to its market capitalization. So here's Canada in the top left, here's China just above me here, and you can see how huge Alibaba is relative to the rest of the Chinese equity market. Now, if the squares are colored red, it means there's been a loss year to date. So, for example, Alibaba has fallen about 27% since the beginning of 2022. Now, notice the companies which have sold off a lot tend to be those internet growth type companies. And that's true both in China, but also to some extent in the United States. So really, this is part of a broader risk-off move in markets. It's not just about China. Although, of course, China has its own idiosyncratic risks, such as its zero COVID policy, which has proved fairly disastrous in locking down large parts of Shanghai, for example. Personally, my biggest concern about investing in China or emerging markets at the moment is that you're simply swimming against the tide. To see what I mean by that, this shows you the S&P 500 in the top panel, that's the US equity market. And what I've done is I've shown you the peak of successive rallies in the US with these dashed red lines. And I've extended those down into the bottom panel, which shows you the Chinese equity market, that's the Shanghai Composite Index. Now notice that generally when the US is rallying, so is China, and also when the US reverses, China can't resist that downward pull. So in other words, it's very difficult for China to swim against the tide of risk appetite, which is pretty much set by the US. The US is like the gravitational pull, if you like, which creates the tides, and China simply rides along in those lunar tides. Now, the reason behind that is pretty obvious, which is the size of the US market. If we look at the market cap weighting for the MSCI ACWI index, for example, that's a market cap weighted global index, you can see the US's weight is about 61% versus China, which is just 3.2%. So, of course, the bigger market is the predominant driver of risk appetite globally. And it's not really possible for a small market like China to swim against that very large tide created by US risk appetite. Another way in which America dominates is via the central bank policy from the Federal Reserve. Of course, at the moment, everyone's worried about interest rate hikes. That's a raising of interest rates by the central bank in the US. And if you look at this table beneath me and you know how to read it, that's a future video, then you can see that there are actually lots of hikes priced in. Not just the normal 0.25% increments that you'd expect, but the Federal Reserve is really slamming on the brakes. In fact, the next meeting, they're expected to raise interest rates by 2 notches, that's 0.5%. The next meeting by 3 notches, that's 0.75%, then another 50 basis points, and then another 25 basis points for the next meeting. So these are a very rapid set of interest rate increases, and that usually shocks the equity market in the US when it happens, and usually you get a pullback of risk appetite, both in developed markets, but even more in emerging markets. To see this in action, if we look back at the last interest rate hiking cycle, the complete one in 2004, you can see that the Federal Reserve started off at an interest rate of 1% and then very gradually increased it to 5% over the course of about 2 years. Now in the top panel, this blue line is that Shanghai Composite Index divided by the S&P. So when this thing is falling, that means that China's underperforming the US. And that was the case during that entire rate hiking cycle. You can see that this line has gone down as interest rates went up. Only when the rate hiking cycle ended did we start to see China really outperforming the United States. So in conclusion then, we don't actually know exactly why Charlie Munger's cutting exposure to Alibaba. It could be just that he's moving away from ADRs towards buying stocks directly in Hong Kong. It may be that the company needs the money, or maybe he's just not so bullish on China. But I think it's fair to say that he still holds a position, so he's not completely cutting that bet. Personally, I'd be cautious about getting exposure to China or emerging markets right now because we've got this combination of very high inflation, a Federal Reserve which is seen as maybe getting behind the curve and tightening things very rapidly and also shrinking its balance sheet, and also this disastrous policy of zero COVID in China. All of those mean that investing in China right now, I think, would be too risky. Also, as we saw, China is swimming against the tide of risk appetite, which is generally falling. And that's a very difficult story to tell as being bullish for China. So personally, I think that China's underperformance will continue towards the end of this year. So remember, the purpose of this video is not to scare you or to stop you from investing in equity. In fact, I'd be doing the opposite, which is buying more as valuations go down. But I wouldn't get too much single name exposure, particularly in EM like Charlie Munger's got right now, and I wouldn't get too much exposure to China for the reasons I've already stated. Now remember, we're also offering our membership on our website now, pensioncraft.com, if you want to learn more about that, and you'll find a link beside me and in the description beneath me if you want to learn more about that. And as always, thank you for listening.